President Trump has abruptly axed Federal Reserve Governor Lisa Cook, raising questions about political influence at the Fed, global currency tensions, and also what her replacement could mean for interest rates and markets. Let's bring in David Scutt now from StoneX. Great to see you. Obviously, so many questions about this one. We've got presidential power. Does he have the power? Is it an overreach? What happens to government institutions? What's your view?
G'day, Aaron. Great to be back. Look, what we're dealing with right now is unprecedented, especially for a global reserve currency like the US dollar. Of course, earlier this week, Donald Trump, Truth Social, putting out a post saying that he's removed Lisa Cook, who is due to be in place on that FOMC Governor Committee until 2038. Now, the reason behind that is very, very intriguing, and where it could go and lead to financial markets, for interest rates, for the US dollar, is really, really important for global markets.
Yeah, how much power do you think Fed governors really hold beyond setting rates?
Well, they are much more powerful than the regional Fed chairs for the various institutions that they go, and also form part of the committee. So there's 7 governors, and at the moment, Donald Trump has got 3. And we've got Jerome Powell, who's due to go and end his chairmanship in May next year, but his actual term as a governor does not go and end until January of 2028. So he's looking to go and get a majority on that board, because the power for the governors is not only to go and set interest rates, but also to go and determine those regional Fed chairs, who they go and put in place in those particular institutions as well. And that can be the ultimate power, because anyone who does not go and toe the line when it comes to what Donald Trump is looking for interest rates in the future could find themselves out of a job pretty quickly.
Yeah, and I mean, look, we see it on both sides of politics. It's very common to appoint people who agree with opinions. We see it in the legal. President Trump was accused of doing that in his first term with the Supreme Court there as well, with a number of nominees he put forward. Do you think that another dovish appointee could tip the balance, though, at the Fed?
It could, because at the moment, let's go and set the scene. We've got about 100 basis points worth of rate cuts that are being priced by markets for the Fed out to June next year. Now, that's fine if the markets go and think that the policy is being set for economic reasons. But if we see that policy starts to be skewed towards political reasons rather than actual economic, that's where things could get really unruly when it comes to some of these market movements. Because at this point in time, remember back earlier this month, Donald Trump was talking about wanting to see the Fed funds rate at 1%. It's currently sitting at 4.25 to 4.5. If that happens, then we could go and see a really, really big move, not only in the US dollar, but in long bond yields in the United States.
Talk to us about this pricing chart.
Yeah, so this is basically just going back to looking at what the markets currently have priced in for the Fed right now. That's 100 basis points, 102 basis points now, priced into June next year. So that's what's in the markets right now. But this is where it comes interesting. If Cook was to go and leave that position and we get another really uber dovish appointee, what will they then go and start to go and guide to? We know that there's some other members on the committee who are already looking to go and cut rates. They are Trump appointees as well. Will they be really aggressive though? And that's where the markets don't really know exactly what to go and expect, because if we do go and see policy set for political purposes, not for economic purposes, we can see when it comes to the back end of the Treasury curve, they will get belted. You will see yields sharply higher, and would also see the US dollar likely fall like a stone. So that's the scenario when you start seeing policy being set not for economic purposes.
Yeah, let's talk about the US dollar though, because there is so much going on in the world. You've got BRICS, you've got India and the United States, and you've got India getting closer to China and Russia as well. What does all of this mean for the US dollar, and what's the greatest risk or reward for the US dollar at the moment?
Well, right now, it's already moved quite a bit this year. We know that's a lot weaker than what it was at the start of the year, and that's partly to do with some international concerns about trust in the US administration when it comes to policy settings, and also more recently, what may be going on when it comes to the Fed in the future. But when it comes to some of those other factors out there, we know that every other economy, particularly those who have been hit pretty hard by tariffs, want to go and likely have a cheaper currency as well to go and make themselves more competitive when they're trying to go and import into the United States, etc. So we run the risk that if we see the US dollar start to go and weaken, that other central banks around the world start to go and set policy, should I say, to go and try and counter that. And when you have a currency war, it leads likely to a lot of market volatility, the potential for a pickup in inflation again. And that's what markets don't really have premise at this point in time. It would be very, very good for hard assets that have a scarcity value in an environment like that, where you have every central bank trying to go and outdo each other.
Scotty, do you think that we are actually heading towards another global currency war, though?
I do at this point in time, because
Really?
if you think about if the US dollar starts to weaken appreciably, that's going to put a lot of pressure on the euro. Now, the euro at this point in time, already the EU has got inflation back at target. It's a slow growing economy, and we know in the past they've really struggled to go and stir inflationary pressures. You can say the identical as well for Japan. More recently, yes, inflation pressures have picked up, but over the course of decades, they've really, really struggled to go and generate any inflation. So if they have much stronger currencies coming through, that's going to be problematic for them, and they'll look to go and counter it. So to me, like, I've already seen this instances in the past. A lot of the time, the US has not really engaged it, maybe for a little bit of period coming out of the GFC. But when you're dealing with the global reserve currency, if it's been actively trying to be weakened by the administration and the central bankers on board with that, then it's going to lead to a lot of volatility out there. And you'd see, I'd imagine, some pretty big gains coming through in commodity markets and commodity prices, especially those that are very difficult to go and mine and don't have the infrastructure to go and make that supply.
Let's talk about Australia. How do you think recent inflation signals in Australia actually are complicating the RBA's outlook? Because Melbourne Cup Day could go any way.
It could. And I know that the inflation indicator yesterday for July got a lot of eyeballs. But what you've got to do is you step back and actually look at some of the compositional changes that actually led to that. Now, the big increase that we saw in the headline, I think, went from 1.9% annualised to 2.8% and 2.1 to 2.7 when it comes to that trim mean measure on an annual basis. A lot of that was entirely due to just the timing of electricity subsidies. Now, forgetting the politics about what's actually doing to the data and suppressing the actual true inflation rate, that's likely to go in reverse next month. But one thing that we are looking very closely at here at StoneX, and I know others are doing it as well, is what's going on when it comes to some of those really key housing components, like cost to go and build a new premises and also rents, because they make up over 15% of the entire CPI basket. Now, you can see, looking at here, I've just stacked it on top of each other. For a period of time, we've had what's called a disinflationary trend. We're seeing that gradually over time, that inflation pulse has started to go and die off. Until recently, it's too early to go and determine whether we've actually seen a turn. But at this point in time, it looks like, particularly when it comes to those new dwelling costs, they're starting to go and pick up again. Now, that is problematic for a central bank that's looking to go and ease interest rates as soon as November.
Why?
Because if you start to go and have inflation expectations and you have the biggest components in that inflation basket pushing higher again, then all of a sudden you have this dichotomy where you've got to go and make a choice between, do you go and prioritise the inflation target or do you prioritise the full employment target? I suspect the RBA will go and do the latter, but then what does that mean for inflation? That's the question. The economic textbooks would go and tell you that you'd see inflationary pressures die down again. But as we've seen for a period of time, inflation has been pretty sticky, not only here, but other parts of the world. So it's just going to be one of those environments where it's going to be either not so great or even worse. And that's not an ideal scenario for anyone.
It's funny, isn't it? It feels like we're talking about COVID all over again, how much longer it's going to go for, the idea of inflation. We keep hoping things will change. We keep looking for improvements, but it keeps lingering there as well. We're seeing that right around the world too. And in Australia, housing is such a big one. What about the labour market though as well? What impact could that have for the RBA?
Well, that's the key swing factor. I know that the inflation pressures are one thing, but I know that when you look at the commentary from the RBA that's come out recently, it has been all directed towards the potential downside risk to to its full employment mandate. So if it sees another increase coming through in unemployment, it's very, very likely that it will still want to go and ease on the belief that that inflationary pulse that potentially might be starting to come through is unlikely to be sustained. So to me, rather than the inflation indicators, they're nowhere near as important as the monthly employment report. So we'll get one early next month, the middle of next month, and that's going to be the really key swing factor as to whether the RBA could go and cut as soon as September, but more than likely in November.
Yeah, there's going to be a lot of traders watching very closely to see what's happening there with the Fed, the ASX, and also the currencies. Always appreciate your insights. So much to get through today. Thanks so much.
Great to be here. Take care.